The Producer Price Index, trade services, margin prices, and tariffs. The Producer Price Index measures the changes in prices that producers receive. We survey thousands of U.S. businesses each month for their actual price data. Collecting business receipts, as opposed to collecting what people pay, means the PPI collects price data for all types of buyers and for transactions at every step of the supply chain. Think of the chair you're sitting in. The PPI would be able to tell you the price changes for chairs, but also every step and component of production as well, including the factory cushions, the nails, the wood, as well as the warehousing and transportation services as it moves from manufacturer to wholesalers and then to retailers. BLS's PPI is recognized as one of the federal government's principal federal economic indicators for its coverage of changes in prices across the economy. We are all about numbers and data, so here are a few key numbers about the PPI. The PPI tracks prices for approximately 64,000 unique goods and services from over 16,000 sampled firms. PPI publishes about 10,000 indexes for individual products and groups of products every month. The PPI provides data for over 500 industries. For the classification of industries, we use the North American Industry Classification System, NAICS, a standard system used widely by the federal government, providing comparability with industry-based data for other economic programs, including productivity, employment, wages, and earnings. The Producer Price Index is actually a family of over 10,000 detailed indexes published every month. The breadth of these indexes represent multiple perspectives and allow you to make critical analysis of many different components of price changes. Our indexes come in many different types. For each of these index types, the same pricing microdata is organized differently to measure producer prices from various perspectives. We have industry indexes that measure price change for the output of an industry. Commodity indexes, where PPI has organized products and services by similarity or material composition. Net inputs to industry indexes that measure price change for the inputs consumed by an industry, excluding capital investment and labor. Final demand and intermediate demand indexes regroup commodity indexes for goods, services, and construction according to the type of buyer and the amount of physical processing or assembling the products have undergone. Intermediate demand indexes track business-to-business purchases, excluding capital investment. The goods and services included here will be used for further production. Final demand indexes include pricing information received by producers from sales made for personal consumption, capital investment, government use, and exports. Final demand indexes are intended to capture the final transaction between a producer and consumer. These are the top contributors to final demand, the PPI headline number. Healthcare services is the largest at 17%, followed by wholesale trade services and retail trade services. Combined, wholesale and retail trade services account for nearly 20% of final demand. A key thing to note is the word services in both titles. Wholesalers and retailers do not produce the goods they sell. They provide a service. Wholesalers facilitate the transfer of goods from the manufacturer to another party for resale. Wholesalers provide services such as buying and assortment building, bulk breaking, warehousing, transporting, and bearing risk. Retailers facilitate the transfer of goods from wholesalers to the general public for personal or household consumption. Retailers provide services such as marketing, storing, displaying goods in convenient locations, and making the goods easily available for customers to purchase. In both cases, little, if any, transformation of these goods takes place. How do we measure the price of these services? There are multiple prices for a product as it moves through the supply chain. At the beginning of this simplified supply chain, the Producer Price Index measures the change in the prices producers receive for the products they make. At the end of the chain, the Consumer Price Index measures the change in the prices consumers pay for the products they purchase. But as I said, wholesalers and retailers are providing a service, not manufacturing a product. BLS measures the price of these trade services by calculating the gross margin. The gross margin is the difference between the selling price of a good and the replacement cost for that same item. Gross margin prices reflect the value added by the establishment for the services provided, rather than the price of the good itself. While this margin includes profit, it is not the same as the establishment's profit margin because it includes labor and other overhead costs. For a wholesaler, the gross margin is the difference between the price they pay to the producer and the price they receive from the retailer. For a retailer, the gross margin is the difference between the price they pay to the wholesaler and the price they receive from the consumer. Our preferred type of price to collect for retail and wholesale trade services is the average gross margin per unit for a comparable product line. BLS often prefers to include average or unit value prices in the Producer Price Index for industries in which there are large numbers of homogeneous products or services provided at different prices. There are several benefits of average prices in these circumstances. Item sample sizes are greatly increased, providing a better representation of an industry's production. Also, average prices eliminate the need for frequent substitutions, and they better reflect competitive pricing and price adjustments than a single transaction. Comparable product lines are groupings of related products that are distributed under a similar set of conditions. To be considered comparable, products included in the average must be homogeneous, able to be substituted for each other, priced on the same per unit basis, marketed under similar conditions to a similar demographic market, and sold to the same customer class. These groupings should maintain a constant level of service being provided to sell the products included in the average. Basically, the product characteristics are used as a proxy to represent the underlying services provided by retailers and wholesalers, since different levels of service are associated with different types of products. For example, the services a supermarket provides to sell shelf-stable canned goods are different than those needed to sell perishable produce. Averages are defined at different levels based on these characteristics and depending on data availability. Some report a broad product line average, while others provide a very narrow average margin for a specific product. Averages can be national, regional, or from a single location. Margin prices based on transactions for a single product are acceptable when an average prices cannot be provided by a company. That's the methodology, but let's look at a practical example. This is a hypothetical example of how we might collect a margin price from a toy store. None of this data is from an actual respondent, as we maintain strict confidentiality of all respondent information. Each month, we ask our survey respondents to update their prices for the set of items that were selected when they were initiated into our survey. The item in this example is a comparable product line that includes all plastic dolls and action figures for ages 4 and older. The type of average and time frame used to calculate it also remain the same every month. So in this example, the price would be a company-wide average for all in-store sales of this product line over the first 2 weeks of the current month. Each month, the respondent updates the retail price, which is the average price they received for these products, and the vendor price, which is the average price they paid for these products. Our system then automatically calculates the average gross margin price. Now, a frequent question we've heard recently is how do tariffs affect the PPI? Stepping back from trade for a moment, for goods manufacturing, tariffs are explicitly excluded because they are not retained by producers as revenue. However, pricing decisions producers make in reaction to tariffs are included in the PPI. A domestic producer may raise prices to maximize revenue if their imported competition is subject to new or increased tariffs. They may also raise prices if tariffs increase the prices of their material inputs. Or, if their products are subject to tariffs by a foreign country, they may lower their prices to better compete in the export market. Focusing back in on trade services and our margin price formula, increased tariffs would probably increase the replacement costs. The retailer or wholesaler must decide how much of that increase to pass on to the buyer, if any. They may want to maintain competitive pricing and retain customers, so they don't pass on the full increase, which means the margin price decreases. They may pass on the entire increase to protect their margins, which means the margin price stays the same. They might want to hedge against future increases and raise prices by more than their actual costs, which means the margin price will increase. Decreases in tariffs would have the same potential outcomes, all depending on how and when the business decides to change its prices relative to the changes in tariffs. This is not specific to tariffs. This applies to any changes in a retailer or wholesaler's acquisition costs. Okay, time for a pop quiz. If a new tariff increases the acquisition cost of a good 20%, and a store increases the retail price of that good 15%, what will be the change in the margin price? Will it be a higher margin, a lower margin, or no change? Well, this was a trick question, because the answer is, it depends. The percent change in the retail price and the acquisition price are not enough information to answer the question. You need to know the actual prices to calculate the change in the margin price. Let me show you a few examples. Let's go back to our previous example. Again, these are not real prices from a real respondent, just a hypothetical created to illustrate the possibilities. Using the original values and applying a 15% increase to the retail price and a 20% increase to the acquisition price, in this case, results in a 6% decrease in the gross margin. The nominal value of the change is a decrease of just 24 cents. But what if we had a slightly different set of starting values? In this scenario, the retail prices are the same as in the first example, but the vendor price for June is slightly lower, $14.72 instead of $15.88. Using the same percentage increases of 20% for the vendor price from May to June results in no change to the gross margin. And in this third scenario, with a May vendor price of $13.35, those same 15 and 20% increases result in a nominal increase of 4%, or 27 cents for the gross margin. Seemingly small variations in prices can have noticeable impacts on the amount and direction of price changes, especially in the retail and wholesale trade industries, where the PPI methodology includes both the sales price and the acquisition cost to calculate the margin price for the services these companies provide. PPI data are available on our website. You can also access our methodology online, including the PPI Handbook of Methods, quality adjustment information, and industry fact sheets. If you need assistance finding anything on our website, please contact our public information section at the email and phone number on the screen.